You're listening to the Good Question Podcast with Richard Jacobs. Our goal is to make each of our guests exclaim, that's a good question. I don't know the answer. Because when that happens, it means you, the listener, may be inspired to learn more beyond the interview and to ask great questions yourself that lead to new insights. In this podcast, we cover historical and current anthropology, comparative religion, and history. Welcome, and let's get started.
Hello, this is Richard Jacobs with the Good Question Podcast. Very interesting guest today. He's got a new book out called The Price of Time, The Real Story of Interest. His name is Edward Chancellor. He's a financial historian, a journalist, and an investment strategist. So welcome, Edward. Thanks for coming.
No, thanks for having me on your podcast.
Yeah, let's just tell listeners a bit about your background and, some of the work that you do today, and then we'll get into the book.
I've been working in the financial world for a little more than 30 years as in a variety of jobs, starting as an investment banker, then as a financial author working on books, financial journalist, and then after that as an investment strategist working in asset allocation. And about 10 years ago, I jacked in that job and went back to writing full-time, spending most of my time writing the book we're going to talk about.
Well, I hope it's not intrusive to ask you, but what made you leave the world of finance and go to writing?
I don't know how much you know about the sort of division of labor in the financial world, but I started off in what we now call M&A, or what was then called corporate finance, and it didn't suit me at all. Actually, it's M&A is really about drumming up deals,
mergers and acquisitions,
and extracting fees. That's the real aim of the game. It's pretty harsh work. I couldn't for the life of me see that it added much value to our clients, and I found it sort of boring and depressing. So however, I did discover that I had a certain sort of aptitude for thinking about finance, and I had been trained as a historian. So at that moment, I embarked upon writing a history of financial speculation, which was published in 1999. It's called Devil Take Hindmost. And I really at that time, I suppose I discovered that I had a certain aptitude for looking at what was going on in the financial world and finding curious and interesting parallels in earlier periods. And it also turned out that this was not, although this is sort of interesting field, there aren't that many people occupying it. So there wasn't a huge amount of competition, which is always a good thing.
Yeah. I mean, did you know, I guess David Graeber, I think he did that the first 5,000 years. If there's not many people in the industry, you probably all know each other. Right?
No, I didn't tell you the truth. When that book came out, I was working in Boston for the investment firm. And I think Graeber's more of an academic anthropologist, whereas I've been really for the last 25 years, I've really looked at the world through the prism of how an investor would look at it. In other words, one's looking at assets and saying, what's driving these prices? What's underlying it? Are they robust? Is there a bubble going on? I think Graeber, I mean, I found his book quite heavy going and a bit waffly, I have to say, but it did contain an interesting insight, which I actually used, if you remember, in the first page of the new book, where Graeber says that he didn't think that, he thinks of when the economists try and imagine the first transactions, they always think that they were barter transactions. In other words, you imagine you and I living in a primitive society, and let's say I'm making bread and you're going off fishing, and the idea is that you swap two of your fishes for my loaf of bread. And what Graeber said is that the first transactions were credit transactions, which is namely, you're going off fishing and you need let's say, I don't know, a fishing rod, and I've got a fishing rod. So I'll lend you the fishing rod. I'll lend you my boat. So in other words, I think that the first transactions were actually credit transactions rather than barter. And Graeber picked that up. Strangely enough, I'd been thinking about this very problem during the credit boom of the early 2000s, and I'd just sort of arrived just as a sort of thought experiment at pretty much the same conclusion.
Okay. Well, I was going to ask you, not necessarily about Graeber himself, but what involved? You said you were trained as a historian. I think that's very interesting. What's involved in training to be a historian, and how does that reflect on your writing?
Well, I mean, I suppose how I see one's training as a historian is that one delves into period that one obviously doesn't experience at first hand, and one gets a feel from them for that period from reading contemporary source material, which might be, some of it might be related to political events of the day or the economic events of the day, and some of it will come from sort of literature and culture of the time, and one forms in one's mind a sort of a rather inchoate picture of an earlier time, and what you're doing is really multidisciplinary, if that makes sense to you. You're not using a sort of a narrow formal model when you're not talking about a sort of a scientific method. You're really using a more multidisciplinary, intuitive method. In the end, the way I feel is when you sense that you were developing a capacity as a historian, you had a feeling that something sounds right, and you also have a feeling when something sounds wrong. In other words, you're sort of honing these intuitive antennae, and I think that's also true really about the investment world, where you really need and this was a point I think made most forcefully by Warren Buffett's partner, the late Charlie Munger, about how investment is very multidisciplinary. And history and a knowledge of history is one of the disciplines that good investors tend to take on board. And along with a number of others, psychology or an understanding of business strategy, an understanding of accounting, an understanding of evolution, understanding of science, understanding of group behavior, whatever. So I mean, I think one can transition from having learned these, if you will, the soft skills of a historian. I think they transition quite well to thinking about finance and investment, and they also turn out actually to be much more useful skills in identifying what's going on in the current world than actually a formal economist training. I mean, for instance, when I'd been at school, and when I mean school, I mean real school, not university, I had studied economics. I was a good economist at school. However, I was a bad mathematician. So they said, you can't read economics at university because your maths are not up to it. But actually, when it came to, the last 25 years, when it came to analyzing for instance, the internet bubble in the late 1990s, people who were historians like me had no trouble identifying what was going on. And of course, it's pretty obvious in retrospect, but what it's easy to forget about is that, at the time, whole swathes of economists were saying that, bubbles didn't exist. And whereas we we historians, we looked at, I look at the internet bubble. I wrote a chapter in my history of financial speculation saying this looks just like the railway mania in Britain in the 1840s. As incidentally, the AI tech boom today. And then if you go into the credit boom and crisis, again, if you're aware of history, you saw these, countless periods.
Yeah, that's good.
Strong credit boom.
It seems like being a historian, I guess, is you're studying context over and over and over. Like in order to figure out the history of something, again, it seems like you need to understand the context of what were people like at that time, what were people like in that area, what was important to them, what were their values. Does all that have to come first before you consider the particular history you're looking at, or like how important is all this context when you're researching?
Well, for me, it is. I mean, I don't have. There's a famous book, famous history of speculative booms and busts, called Manias, Panics and Crashes by someone called Charles Kindleberger. And Kindleberger, it's a great book. And Kindleberger, in that book, published, sometime mid-1970s, he sets up to create a sort of taxonomy of the speculative boom and the bust. And I saw Kindleberger when I was writing my book. And I said, well, what I'm trying to do is to place every boom within the context of the period in which it occurred, to try and understand what life was like in Holland in the 1630s at the time of the tulip mania, or life in the United States in the 1920s, or Japan in the 1980s. So I tried to my approach is to really steep myself in a period with not really thinking too deeply about where I'm actually going. But once I'm steeped in it, I hope to sort of be able to find enough material then to sort of put together an argument, and then to describe earlier periods, and then to sort of gently draw attention to things that appear similar and perhaps things that are a bit dissimilar, just to use that as an additional framework for understanding what's going on.
What makes it hard to research a particular type of history? Is it, if something's from 1,000 years ago, by definition, it's going to be a lot harder than 200 years ago, or certain cultures were known for writing stuff down and certain were not? Like, what makes history difficult to unearth?
Actually, I think it's rather the other way around, that the closer you get to current day, the more information you have. The more information you have, the less comprehensive your understanding is going to be, and therefore, in a way, even before you set out, you will already be excluding vast amounts. Now, I mean, in this latest books, I start off by writing about the evolution of lending and the charging of interest in ancient Mesopotamia. Now, this is not my field, sir. I would, when I was reading about it, I wish it had been my field, because it seems it's so fascinating. But there's limited, from what I can gather, sort of limited evidence available, largely from bits of pottery and clay and inscriptions. You can piece together what was going on, and because you don't have a huge amount of information, you can sort of draw you can sort of draw everything from this period. Whereas you come into the modern day, I mean, you couldn't, let's say, writing about finance, there's no way that you're going to be scratching more than a millionth part of the available data. So I think, as I say, I like sort of earlier periods, because one feels less overwhelmed by the amount of information that one might be passing by.
Interesting. What about other history books that are written about a particular subject? Is it useful to go through them and all the references, or does it actually hurt you to do that? Or should you do that after you do your initial review or before?
No, I mean, it's difficult. My wife's a philosopher. She always thinks that you should only deal with primary sources. But I didn't agree with that. My view is that, my typical approach would be to read the second, and then you see what they have in common. You see where they disagree in their interpretation. And they also point you to the primary sources, and then primary sources you can then go to. And you remember I was saying earlier about, as you delve in, you start developing an intuition. Say, well, I like this interpretation more than that, and then you perhaps you find more to support that argument when you look at the primary material.
Okay. So let's get into your book, The Price of Time. What motivated you to write it? What was going on with you where you thought, I need to put all this together and put a book out about it?
Well, I mentioned that I'd written in the 1990s a history of financial speculation. I was sort of interested in the boom and the bust of the late 90s, early 2000s. I then, in the early 2000s, I wrote a report. It was sort of book-length report, but it went out to limited readership, called Crunch Time for Credit, and it came out in 2005. And that was really interested in the credit boom, as the title suggests, where that was leading up. And then we had the global financial crisis and the bust, and interest rates went down to zero in the United States, first time ever, and they went negative in Europe. And I saw a lot of what I felt were distortions in the investment world, and really some sort of dislocations going on in society. And I felt that a lot of them could be explained, a lot of these problems or financial distortions, economic problems, social economic problems, that if you could trace them back to the consequences of the ultra-low interest rate. I felt you wouldn't, when I was working for the investment firm in Boston, really didn't feel you could understand anything that was going on in the investment world unless you understood the impact that the ultra-low rates were having on for instance, valuation of assets, the allocation of capital flows between countries, and so forth. I wouldn't bother to write a book on the subject if I felt that there was a book that you could reach out to and it would give you all the answers. I felt as I started to read around the subjects that no one had really tackled this subject for a very long period of time. It really, probably, for 100 years or so. So that's, I think, do you remember that I have an epigraph at the beginning of my book saying, from an Austrian economist called Eugen von Böhm-Bawerk, where he says the subject of interest has long been the victim of contemptuous neglect. But Böhm-Bawerk wrote that in sort of 1890 or thereabouts. And I was, doing this work 125 years later, and it was, the neglect was still there, and therefore I thought that I should write, which is, what I did.
Just to jump ahead, when you look at the totality of financial history as far back as you understand it, what does it look like to you today? Are we simply repeating what has been, what's happened over hundreds of thousands of years? Are we entering a new realm or new era of uncharted waters? Like what do you see?
Well, I think there are waves of repetitive. As my friend, the American financial historian and journalist Jim Grant, I think he says, in science, progress is linear, but in finance, sick. Or Jim also likes to say that we keep on stepping on the same rate. And that's true, fair enough. However, finance has, definitely has changed in the last 50, 60 years. We've moved off a monetary system based on gold. And remember, I write in the book that finance in theory should be a sort of mirror image of the real world, but it sort of takes on a life of its own, and the real world becomes almost an image of finance rather than the other way around. So I think I use the language of hyper reality, that like you find in I write about how finance become like the Truman Show, where everything's fake, or the hyper reality of the Matrix or the like. And I think finance has become sort of hyper real, a copy of a copy of a copy, and that makes one. I think that's, you could say that's been a really long progress. The shift from metallic-based commodity currencies to pure paper. But it's one that I think it does take us, as you say, into uncharted water. And we have, in case you haven't noticed, been living through quite literally the most speculative period in the entire history of mankind the last 5 years. Almost endless succession of bubbles and a rolling series of crises. And losses after each bubble are greater than the losses of the previous bubble.
Who is bearing these losses, these sequential losses, and who is not?
Well, that's a good question, because who isn't bearing the loss or hasn't been in aggregate has been the investor. The wealth, recorded wealth, continues to escalate up to ever higher levels. So while investment community takes a hit when say the dot-com bubble bursts or when Lehman goes down, but in a very short period of time, overall wealth is back up higher than it was before. And I'm right about central banks lowering interest rates, and the support of the central banks will say, well, their aim was to get the economy going again and reduce unemployment. Say that's fair enough. But what I'm trying to point out in the book is that there are endless unintended consequences from this policy of manipulating the interest rates down, and that those unintended consequences feed through to society as a whole.
I've been hearing a term, I guess a blanket term is called financialization. I've been hearing it all of a sudden in different news articles and from certain people I speak to and all that. Do you address that in the book? And, can you speak to financialization? What is that? What does that mean? What does it do to society?
Well, financialization can mean different things. One way of looking at it is just the growing role of finance within an economy. Now, the U.S. financial sector used to be around 2.5–3% of GDP back in the day, and I haven't looked at it recently, but it went up to at least 3 to 4 times that figure. And you have the financial sector producing a great amount of the aggregate profitability in the economy, and the growth of the financial sector playing a leading part in generating economic growth. Now, finance is really just meant to be an assistant to the so-called real economy. So what financialization means in broadest terms is that the economy has become, the finance is no longer the servant economy, but the master of the economy. And you can then see financialization at a lower level, where investors and executives manage their investments purely to generate higher investment values rather than the underlying value in the real world. So, let's say you have a choice between investing in a new plant or buying back your shares. So investing in a new plant is investment in the real world. Buying back your shares is, a financial or financialized activity. And what we've seen, is probably aware, what's really been going on for 20 years or so now, is companies spending more and more money on buybacks, share repurchases, and huge expansion in private equity, which really is same as the share buyback, but just buying back the whole company with debt. And when we talk about financialization, it's where financial activity is pursued rather than investment in the real economy. There is a line I cite in the book, sort of amusing quote by some London economist who says that in the age of finance mostly finances finance. So that's sort of financialization in one sentence.
Do you see that the behavior of investors and people with large sums of capital is getting more mercenary? Is it getting more thoughtful? Which way is it going? Is the financialization becoming more intense? And again, are people's greed and lack of care for others, is it getting worse or getting better? What do you see?
Well, I'm not particularly interested in using the language of greed. I mean, what has happened, and it's really not the subject of my book, but clearly what's going on is the system is being put more and more on autopilot, because as you must be aware, we have this tremendous growth in indexation of people not actually actively managing their money, but putting it into indexes like Vanguard or Fidelity, all those funds managed by BlackRock. And so everything's on autopilot. So I think when you have, more than half the market on, given over to indexation, where, shares are bought and sold pro rata, just depending on where, what their current market value is, what the current market capitalization of that business is relative to the index, that's a market that clearly isn't more thoughtful.
I see. So the companies that are in an index will get pulled along with what the market's doing, regardless of how that company is doing.
Yeah, I mean, obviously you have people at the edges, trying to price the stock, but the movement, the money flowing in and out of indexes have a tremendous impact on the overall valuation of the market. And we at the moment, we have this period, we're living through a period in which a very small number of stock, people talk about the Magnificent Seven, but, let's take 40 stocks, top 40 stocks. They now account for roughly 60% total market capitalization of the US stock market. So a very small number of stock. And, we see that from time to time. We saw it in the so-called Nifty 50 boom in 1973. We saw it at the peak of the internet bubble, 99, 2000. We see it again today. And that is, when you have a market highly concentrated like that, and today it's driven, as I say, by indexation, those are often the signs that, that's often taken as a red flag that the market might be headed downwards pretty soon.
What happens when, one or more bubbles burst, let's say, where the temperament goes towards fear now, and there's so much money in the indexes? What do you think the consequence will be? How will it look different when it happens, a downturn?
Difficult to say. I completely understand the reasoning behind indexes, that that it's difficult to find any investor who's going to outperform over a long period of time. And their investment fees are very high relative to the value added by the investment world. So I'm pretty sympathetic to growth of investment. However, once you have a market that is dominated by passive investment, then I think it does become a bit untethered. And what I would expect is that, I suppose the way I look at it is once indexation has reached a certain point, it's gone a bit too far, and therefore you have an opportunity for people to come back and, prudent contrarian investors to do a bit better. So I would sort of imagine a world in which indexation, having sort of made these tremendous advances over the last 40-odd years, goes into reverse.
Oh, really? So you think there'll be a flight from capital from indexes into individual equities or real estate or wherever it may go?
Yeah, I think that may be wishful thinking, but I think that there are long periods in which, the index as a whole doesn't deliver positive returns. Like, and we take the US, between, I think, 1965 and 1980, the US market delivered, no returns to investors. And that's quite a long time to wait. And for a period like that, we're coming off this period in which run up, we take the last 25 years, you had your bubble, then you had your bust, then you had another boom, you had another bust, then you had a very, very long bull market, and the stock market went up, very high levels, and you got, frankly, indexes, did very well. They were low cost and they beat, 98% of the competitors. So what's not to like? But if you go for a period in which, the market is flat or down over 10 or 20 years, then, some people are going to be doing better than that. And then, investors being, what they are, they will flock to those who are doing a bit better. So I don't know, I think there'll be, there is an equilibrium between indexation or passive investment and active investment. I don't quite know where it lies, but I imagine, there will be some retreat from the indexes at a later stage.
So what would you say is the effect of low, and I know this gets into your book, but, the effect of low interest rates on the common person's ability to invest and or save money and earn a return on that money, so at least they can save for a number of years to buy a house or do whatever they want to do, get enough interest on their money that they're not outpaced by...
Well, one of the points I make is that the less capital you have, the more of that capital, more of your savings is actually likely to be in cash. The richer you are, the less that your cash, you may have large cash holdings in absolute terms, but they're going to be a relatively small portion of your overall wealth. So I think that when you take interest rates down to very low levels, as they did in 2008, the person who's hit proportionately worse is a person who's less well off with relatively little savings, which are in bank deposit yielding nothing. And then the markets rebound and overall financial wealth goes through the roof. And who does best then? Well, obviously those who own the existing financial and real assets, namely people who are better off. And then asset prices are at high level. And what it means when an asset price is high level is that it's going to deliver lower returns in future. A stock market yielding 2% or 1% is obviously going to deliver less over the long run than a stock market yielding 10%. What that means is if you don't have any assets and you want to accumulate investments over the course of your life in order to retire, you're going to have to put away more money in order to make your retirement goal. So as I say in the book, the very low rates of interest made life more expensive. Those things in life that offer you security, the value of a house, your retirement pot, even your healthcare and education, all those costs became inflated during the period of ultra low rate. And, people argue, interpret the inequality data, but it seems to me that the haves, the 0.01% of the population or the 1% of the population did much better than the have-not. And I think, to some extent that explains why, America and other places became more socially and politically divisive. It was, the ultra-low interest rate, in my mind, were a socially divisive policy. And the people who implemented them, the central bankers, didn't consider the social consequences of their action. Those consequences were not in their models.
Okay. So, without spoiling your book, The Price of Time, and for people that haven't read it but are curious, what's a quick summary of some of the revelations you expect that they may get from reading the book or understandings?
Well, I mean, a quick summary is that interest, seemingly a boring subject, is actually the most important financial and economic, I don't know what you want to call it, institution, practice. That interest is omnipresent. It affects all actions in the sense that everything we do financially or economically takes place across time. And interest, as the title of my book says, is the price of time. And because time is omnipresent in our activities, so is interest. As someone says, it's the universal price. It's an omnipresent phenomenon. And, I'm not going to pretend that it isn't quite a complex phenomenon. And what I hope I've done in the book, is explained it reasonably clearly and in a reasonably readable and engageable fashion. But I think it's definitely an important topic. So I'm pleased to have written the book.
What kind of comments have you gotten from readers that really, made you raise your eyebrow, that you thought were very interesting or maybe informed your view of things? Anything interesting come out so far?
I think the investment world has been very receptive. The Stanley Druckenmiller, well-known investor, used to run Soros's fund. He called it a tour de force. And a number of pretty well-known investors like Druckenmiller and others have been highly complimentary. And then, on the monetary policy establishment, they don't really like what I've written because they think it's critical of them. So they see the book as a polemic, sort of unhinged polemic. And so there we are. The debt. We live in. It's like so many aspects of the modern world. There is a dialogue of the death in which I feel that the investment world from which I've emerged myself understand pretty well what I'm writing about. And I think the broad readership has, on the whole, been welcoming. You've got your 4+ stars on Goodreads for what it matters, and then the establishment delivered the policies that I criticized. They had their fingers in the air, so they're not listening.
One more question: modern monetary theory, MMT. How does that play into your understanding of what's going on now, and what is MMT responsible for? You think that if it wasn't present there before, wasn't known, or how are previous booms, busts, bubbles, etc. Or how are we affected differently, I guess, today by MMT versus the past? That's a better way to ask it.
Well, the way I see modern monetary theory, people like to sort of curate it as the magic money tree. Do you remember that? MMT, magic money. The way I see it is, we having lived through a prolonged period of rate set at zero, and as I say, in certain countries, negative, it makes money appear free. And if money appears free, you think, well, let's have more of it. Why bother to tax? Why bother to issue bonds? We can just print money. Central bank, the government has a monopoly on production of money. And so there, MMT is sort of monetary crankery that comes out at the end of a very long, prolonged period of very low rates. Now, again, the policy-making establishment, this MMT is all nonsense. But actually, if you looked what they were doing in 2020 during the pandemic, they were, printing money to support government that was, handing out stimmy checks to everyone left, right, and centre. And those stimmy checks were being spent, as you probably know, on buying meme stocks on the Robinhood app. And we were in an MMT world, and that MMT world fed, pretty quickly through to inflation. And then the next minute, everyone was up in arms complaining about the cost of living crisis. Well, what the hell did they expect?
Do you think that taxes are a counterweight, a discipline in people's minds? Well, I still have to pay taxes, and as they go up, I have to pay more. So in one sense, money may be perceived to be free, but in another sense, certainly not. Because again, you have to pay taxes and do other things.
The MMT argument was you don't need to issue bonds or tax people. You raise taxes when there's too much money out there and inflation is picking up. So tax but what the MMT people are saying is not sort of wrong. It's just sort of impractical and a bit utopian. And I'm afraid, the consequences of their policies is in the end, you have higher inflation, and that tends to be followed with higher taxes and higher interest rates, and everyone ends up feeling a bit worse off. And the difference in America, as you're aware, is, the administration has been running an absolute mind-blowing deficit. So the Americans haven't yet tightened their belt, and sooner or later they're going to have to, and then they'll join the rest of the world in feeling a bit glum.
So do you speak to people, I guess, in Europe and other places that are feeling it big time, or, are you just seeing it in the news?
I'm talking, look, I live in the UK, and, we sort of freak out in the bond market in September 22, and since then the government has, somewhat tightened its belt, and the result is we all feel a bit more heavily taxed. And we all feel a bit less well off than we beforehand. So, and whereas Americans, with their sort of, deficit of 7% of GDP and a relatively fast-growing economy, possibly fueled by this massive deficit, are feeling it's still a bit better than, Europe and the UK, where, our economies are stagnant.
Okay. Well, very good, Edward. So The Price of Time, it's available, I guess, on Amazon and wherever books are sold. And, I think it's a very fascinating read. I encourage listeners to get it. Is there any other way for people to follow up? And, do you have a Twitter page or anything where you put out regular commentary? Where can people find out more about your works?
Well, I have a website called edwardchancellor.com, and I write for the Reuters commentary service, Breakingviews. So I post my columns on the website, and I put up podcasts and stuff like that. So you want to see what I'm doing, you just go to my website.
Okay, excellent. Well, Edward, thanks so much for coming on the podcast. It's been an interesting call, and I appreciate your time.
My pleasure. Bye then.
Thank you for listening to the Good Question Podcast. Please email support@thegoodquestionpodcast.com if you have any referrals to great guests for us to interview. Visit thegoodquestionpodcast.com to hear more interviews. And please help us spread the word by rating and reviewing us on Apple Podcasts, iTunes, Spotify, YouTube, or wherever you listen to this podcast.